Welcome to the chapter on risk and return. Understanding these concepts is crucial for making informed investment decisions. In this chapter, we will discuss the different types of risk, the risk-return trade-off, and methods for measuring risk. Risk in finance refers to the possibility of losing some or all of an investment. There are several types of risk that investors need to be aware of, including systematic risk and unsystematic risk. Systematic risk, also known as market risk, affects the entire market or a large segment of the market. This type of risk is inherent to the entire market and cannot be eliminated through diversification. Examples of systematic risk include economic recessions, political instability, and changes in interest rates. Unsystematic risk, also known as specific or idiosyncratic risk, is unique to a particular company or industry. This type of risk can be mitigated through diversification. Examples of unsystematic risk include company management decisions, product recalls, and regulatory changes affecting a specific industry. The risk-return trade-off is the principle that potential return rises with an increase in risk. Investors must balance their desire for the lowest possible risk with the highest possible returns. For example, investing in government bonds is considered low risk, but also offers lower returns. On the other hand, investing in stocks is considered higher risk, but offers the potential for higher returns. The relationship between risk and return can be visualized using the capital market line in the context of the capital asset pricing model. The CAPM formula is used to calculate the expected return of an investment. The formula is written as E of R sub I equals R sub F plus beta sub I times the quantity E of R sub M minus R sub F. In this formula, E of R sub I represents the expected return of the investment. R sub F is the risk-free rate, or the return on a risk-free investment. Beta sub I measures the investment's risk compared to the market. Finally, E of R sub M is the expected return of the market overall. To make informed investment decisions, it is important to measure risk accurately. Common measures of risk include standard deviation, beta, and value at risk, or VAR. Standard deviation measures how spread out the returns are for an investment. When standard deviation is higher, it means the investment's returns are more spread out and thus involve more risk. The formula for standard deviation is sigma equals the square root of 1 over n times the sum of each r sub I minus mu squared. In this formula, sigma is the standard deviation, n is the number of observations, r sub I is each individual return, and mu is the average, or mean, of all returns. Beta measures how volatile a stock is compared to the market. A beta greater than 1 means the stock is more volatile than the market, and a beta less than 1 means it is less volatile. The formula for beta is beta equals the covariance of r sub I and r sub m divided by sigma sub m squared. Here, covariance of r sub I and r sub m refers to how the returns of the investment and market move together, while sigma sub m squared is the variance of the market returns, showing the spread of returns. Value at risk, or VAR, is a statistical technique used to measure the risk of loss on a specific portfolio of financial assets. VAR estimates the maximum loss that a portfolio could face over a given time period with a certain confidence level. For example, a one-day 5% VAR of $1 million means that there's a 5% chance that the portfolio will lose more than $1 million in a single day. Consider an investor who has a portfolio consisting of two assets, stocks and bonds. The investor wants to measure the risk of the portfolio. By calculating the standard deviation and beta of each asset, the investor can determine the overall risk and make informed decisions about asset allocation. Understanding risk and return is essential for making informed investment decisions. By recognizing the types of risk, understanding the risk-return trade-off, and accurately measuring risk, investors can better manage their portfolios and achieve their financial goals. Thank you for watching this chapter on risk and return. We hope you now have a better understanding of these crucial financial concepts.